Welcome to Odisal Associates Accounting and Finance Tutors. Today, we are going to solve some past questions to prepare the students for the upcoming exams. I have 4 questions that I'm going to solve. One will be on business combination and on ratio. Another one will be on consolidation, while the last one will be on associates. We're going to start on the business combination. Question 1. Slink PLC acquired 95% Clifford Limited, paying cash of 2 million. The assets of Clifford Limited were PPE 1.5 million, current assets 0.9 million, and its total liabilities were 0.4 million. Clifford requested for additional consideration of 0.2 million. The fair value of the contingent consideration is 0.18 million. The reason for this was that Clifford Limited revenue will increase by 50% at the end of the year due to excessive sales drive made by the company. Slink Limited accepted to pay this additional amount if this sales target is met. Before acquiring Clifford Limited, Slink PLC already had 20% of Sophie Limited ordinary shares for 200,000 naira. As at then, Sophie Limited retained earnings was 100,000 naira. After acquiring Clifford Limited acquired 50% of Sophie Limited when the retained earnings was 300,000 naira for 90,000 naira. Sophie Limited PPE is 1 million. Current assets 300,000 and total liabilities 200,000. There was a contingent consideration of 100,000 which Clifford Limited agreed to furnish Sophie in 3 years' time. The present value of that consideration was 25%. That is the rate. The question is compute the goodwill, total non-controlling interest, and the total considerations to be furnished by Slink PLC. Journalize the transactions. Okay, in this question, the first thing we need to look at is the group structure. The group structure. So here, Slink acquired Clifford. So the percentage holding of Slink in Clifford is 95%. And then Slink also invested in Sophie directly. Slink in Sophie direct. %20. And then Clifford acquired or invested in Sophie too. Clifford in Sophie, 50%. So you will now see that if you add 20 to 50, you have 70%. What it means is that Slink has automatically become the parent of Sophie, because what it means that Sling has 70% control over Sophie. Now, we want to see the direct control, the effective control that Sling has on Sophie. Because even though he has 75% influence on Sophie, that is not the effective control. The effective control is that Sling has 95% of the 50% that Clifford has in Sophie, and also 20% of Sophie that he acquired directly. So we'll put it this way: the indirect control of Sling over Sophie will be 95% of 50%. That's 95 times 50%. That will give us 47.5%. However, that is not the effective control of Sling in Sophie. This is only the control that Sling has because he has acquired 95% of Clifford. The effective control of Sling in Sophie will be this indirect control plus the direct control. So effective control will be 20% plus 47.5%, which will give you 67.5%. This is the control, effective control of Sling in Sophie. So with this now, we can start computing the goodwill. We have established the group structure. Sling acquired Clifford 95%, Sling acquired Sophie 20%, and Clifford acquired Sophie 50%, making Sling has 70% holdings in Sophie. But however, since Sling did not acquire 100% of Clifford, it means that there is non-controlling interest in Clifford. And again, since Clifford did not acquire 100% of Sophie, it means that there is also non-controlling interest in Sophie. So what we're going to look at is the percentage of acquisition that Sling has in Clifford, and then the one that he has in Sophie, and what that he has in Clifford. Direct in Sophie and indirect from Clifford. So if you add it, the effective interest will be 67.5%. In this case, we are going to look at the cash consideration and the future consideration, which we call contingent consideration. That will make up the total control that Sling has in Clifford and Sling has in Sophie. So we have Sling in Clifford, Sling in Sophie. We are going to calculate the goodwill in double layers. The first one, we are going to calculate the goodwill of Sling in Clifford, the goodwill of Sling in Sophie, and then the goodwill of Clifford in Sophie. That's the first step. After that, we'll now look at the attributable goodwill to Sling. Of course, this is direct, but this one is not direct. So what we're going to do, when we have calculated the goodwill for each of the acquirers, will go down to apply the 95% on Sophie to get the effective goodwill for Slink in Sophie. So we have fair value of cash considerations. Okay, let's put it in thousands. The question says that Slink acquired 95% of Clifford Limited, paying cash of 2 million. So this will be 2 million. They also acquired Sophie, paying cash of 200,000. 200,000. And then the question also said that Clifford acquired Sophie for 900,000. So these are cash consideration. Now, let's look at the future consideration, which is seen or known as contingent consideration. It is contingent consideration because it is based on future occurrence of a certain condition. If that condition is not met, then nothing happens. It's only when that condition is met. That's why it's said to be contingent consideration. So now let's look at the contingent consideration. Fair value of contingent consideration. Of course, in the acquisition of Slink, when Slink acquired Clifford, it was obvious. They said that the fair value of the contingent consideration was 180,000. 180,000. This one, there was no fair value contingent consideration. However, this other one has contingent consideration of 100,000 naira, but that will be in 3 years' time. We need to find the present value of that contingent consideration. So it is the present value that we will use as consideration. Anything outside that will be used, will be like what we call acquisition related costs and will not be part of the consideration. Because we are going to revalue the consideration as the year goes. The fair value of the contingent consideration as the year goes. So the first year, we'll look at the present value. And it says it's 25%. So it will be, when we are calculating the fair value, it will be 1 over 1 point, is 25%, 1.2525 raised to power 3 multiplied by 100,000. This will give us 52,200. That's what it will give us. So if you add this up, you have 2180, 200. And here is 952. Sorry, this is 51. 51.2. 951.2. Okay, we already know that to compute goodwill, it is total consideration minus net asset acquired. Sometimes when we're looking at when we're looking at non-controlling interest, if the company did not acquire 100%, what we do is total consideration plus non-controlling interest plus fair value of consideration previously furnished minus the net asset. But here, we're only going to use the net asset acquired. So we'll compute the net asset of both Clifford and Sophie, and then apply the percentage acquisition so that we only use the net asset acquired. Less fair value of net asset acquired. In this case, we have PPE for Clifford is 1.5 million. For Slink is 1 million. For Sophie is 1 million. So the 1 million goes into the two places because that is the asset. Then current asset. For Clifford is 900,000. For Sophie is 300,000. And then 300,000. Okay, so the total will be total asset. Here is 2,400. Here is 1,300. And here is 1,300. The total liabilities, total liabilities, 400, 200, and 200. So we have net asset. Net assets will be 2 million, 1.1 million, and 1.1 million. However, we know that at the time that Slink acquired Sophie, the retained earnings then was 100,000. So there is additional 200,000 that was as a result of effort of Slink and Sophie put together. So that was not part of the purchases, of the purchase consideration. As at that time, they had not gotten up to 300,000. So we're going to remove the 200,000 additional retained earnings. Less post-acquisition retained earnings. There is none here. We have 200 here, and there is none here. We have 2,900,000, and here will still be 1.1 million. The next thing is you are going to apply the percentage of Slink in Clifford, the percentage of Slink in Sophie, and the percentage of Clifford in Sophie to get the net asset acquired, identifiable net asset acquired. So we have 95%, we have 20%, and 50% altogether. So 95% of this will give you 1,900,000. 20% of this will give you 180. And 50% of this will give you 550. Okay? Now, in order to get the goodwill, you will remove the identifiable net asset acquired from the total purchase consideration. Total purchase consideration. So, we'll give you the goodwill. Gives you 280. This gives you 20, and this gives you 550. However, while this one is attributable to Slink, this one is attributable to Clifford. But we know that Slink only have 50% of this. So we're going to take 50% of this so that that will be added to this one, and then we'll have the total goodwill. So we'll have a goodwill attributable to Slink. Goodwill attributable to Slink PLC. So this is 100% Slink. This is 100% Slink. And this is 95% Slink. 401. I'm disregarding the decimal. Sorry. This one is 401. And this one is 381.14. That's 95% of this. So the total goodwill is equal to this plus this plus this, which will give you 68.114. So that is the goodwill that arose as a result of this consolidation. Okay, so we will continue in the solution. The question says you should also calculate the total non-control interest and the total consideration. So we want to calculate the total non-controlled interest. Slink in Clifford Limited. That will be 5% of Clifford's net asset. Of course, we consider the net asset to be 19. So the 5% is 100,000. Then we look at again Slink PLC in Sophie Limited. Okay, so it will be 20% plus 95% times 50%. This will give you the effective control. But however, if we less it from 100%, we will now have the, the non-controlling interest. So this will give you that will be when we read out this, it will be 60. We had a 60, 67.5. So it will be 100 minus 67.5. That will give you 32.5. So 32.5 multiplied by 1100 will give us 357.5. So that will give us 457.5. This is the non-controlling interest. Okay, the next one is to compute the purchase consideration. Purchase consideration. To acquire Clifford, we have seen that it is 2180. To acquire Sophie, direct is 200,000. Then to acquire Sophie, indirect, it will be that 95, 951.2 that was acquired, that was paid by Clifford, multiplied by percentage holding of Sophie in Clifford, which will give us 903.64. So it will give us 3283.64. So the total consideration is 3,283,640 naira. That is the total consideration. The next step is for us to journalize the whole transaction. Let's do the revaluation of contingent consideration, the one that we computed using present value. We'll look at year two, year one, year two, and year three. So we have revaluation of contingent consideration. The fair value of the contingent consideration is 51.2. Then The present value was 25%. That was a factor we used. 25% of, that is at the end of year one, of 51.20 will give us 12.80, which will give us 64 total. So in year one, at the end of year one, the contingent consideration has been revalued to 64.00. Then at the end, this is revaluation of contingent consideration at the end of year one. At the end of year two, we'll take another 25% of this 64, and it will give us 16.00. If you add it up, that will be 80.00 at the end of year two. Then at the end of year three, we'll get 25% of 80, which will give us 20. So that is 100. Now, let us journalize the transaction. I've already written it out on the board to save time. We will first journalize the acquisition of Clifford by Sophie. We have already completed the goodwill and the non-controlling interest. The PPE that was acquired was 1.5 million, so we debit it. The current assets that was acquired was 900,000, we debit it. And then the goodwill we completed was 280,000. We have also debited it. Then the cash consideration was 1 million. So we're going to credit cash because that's what they're going to pay. Then contingent consideration liability, which is a future payment, we are going to credit it, 180. Then liabilities of the company is 400,000. The non-controlling interest is 100,000. We have a balanced journal. If you did not do the writing, the journal will not balance. The narration is acquisition of Clifford. I just put it in a short form. You can make your own narrative, as journal is. Is what you did that you are going to explain in the narrative. The second step is to journalize the acquisition of Sophie Limited, the direct acquisition of Sophie Limited. Remember that Clifford only acquired 20% of Sophie Limited, and Sophie Limited PPE was 1 million. They acquired 20%, which is 200,000. We are going to debit it. The current asset was 300,000. They acquired 20%, which is 60,000. And then the goodwill we completed was 20,000. We bring it down. Then the cash consideration was 200,000. Liabilities of 200,000 will be credited. But however, that will be 20% of it, 40,000. And then we're also going to credit the increase in retained earnings of 200,000. They acquire 25% of this, which is 40,000. Acquisition of Sophie by Slink. This is also a balanced journal. If you did not do the writing, the journal will not balance. Then the third journal is the acquisition of Sophie Limited. This actually is a little bit technical, and the student has to watch out. Now, when acquisition is made, because we are looking at uh, parents, subsidiary, and sub-subsidiary. That's what we are looking at. It's not a straightforward one. A situation where Slink bought Clifford, and Clifford bought Sophie. So we're going to look at it. All we know is that at the end, we're going to add the assets together, everything. Now, the shortest way I'm going to explain to you is that since the asset is 1 million and we have already removed 200,000, what we know is that the addition of asset must be 1 million. So we're going to remove the 200,000 from 1 million. We have 800,000. This is the shortest form that I am telling you, so that you will not need to go and point calculate again and do percentages and all the rest. Then the current asset was 300,000 and we have already taken 60,000. So we just removed the 60,000 from the 300,000 to get 240,000. And then the goodwill we had already calculated it to be 381.14. So we bring it down. Then the cash consideration was 900,000. So we're going to take the 95% because that is the one that belongs to Slink. 95% of the expenditure of Clifford in acquiring Sophie, the consideration of Clifford in acquiring Sophie. So that's how we got 855,000. And then the contingent consideration liability, the 95% of it, 48,640 naira. Then the liabilities, of course, we do the same thing. The liability is 200,000. We had 40,000 here, so we remove 40,000 from 200,000 to get 160,000. We had already worked out the non-controlling interest to be 357,000. So we added that. And we have a balance journal, acquisition of Sophie Limited, indirect. The first one was direct. This one is indirect. If you did not do the right thing, bringing in goodwill and bringing in NCI that you have computed elsewhere, your journal will not balance. But because we have done what is right, that is why you see the journal balance. Now, at the end of year one, you are going to revalue the contingent consideration at the value as at the end of year one, because we looked at the fair value at acquisition. So what happens is that we have the 20,000 that we got from the acquisition of Clifford. You know, it was acquired with, I think, 100,000. And then we have 20,000 balance. So that 20,000, that is what it is. You charge it to statement of profit or loss. And then the competition we made, 12,800. You add it together, that will be 32,800. You charge it to P or L. And then contingent consideration will take the credit. Revaluation of contingent consideration at the end of year one. At that end of year one, what Clifford promised Slink materialized. So Slink has to settle the contingent consideration. So it should not be contingent consideration liability will be that 20,000 plus, and then you debit it, and then cash, you credit it. Remember that we had a liability. Oh, sorry. Contingent consideration liability will be 180 plus 20. 180 plus 20. That will be 200,000. 200,000. So this is what you are going to pay. The question said the contingent consideration was 200,000, but however, the fair value of the contingent consideration as at then was 180. So at the end of year one, because it's only 1 year that they've made that promise, you have to pay the contingent consideration. That's why we say debit, contingent consideration liability, and credit cash, settlement of contingent consideration. And at the end of year two, remember that the agreement between Clifford and Sophie is for how many years? 3 years. So at the end of year two, to revalue the contingent consideration, you have an increase of 16,000. At the end of year three, you have an increase of 20,000 after the revaluation. We have already solved that one here, and you saw it. So at the end of year three, when what was promised come to materialization, what you now do is to pay the contingent consideration. So that is why we brought the 100,000 settlement of contingent consideration. The question is technical, but easy to answer. So if you look at it, you will be able to understand how it goes. I wish you the best. We're going to solve the next question. Keep on following us. Thank you.